Hi Leeb viewers, welcome to the video for Wednesday, April 28th, 2010. Please visit our website at leeb.com, that's Leeb.com. Renewed concerns over the potential Greek default of its sovereign debt have been felt in worldwide markets in the recent days, especially in Europe. But from our viewpoint, the issue never really went away. Standard & Poor's cutting of its rating on Greek debt to junk status yesterday only served to fuel investors' fears. Credit default swaps, which are essentially insurance policies against bond defaults, soared to record levels, not just for Greek bonds, but for the bonds of other European nations with similar debt problems as well, such as Spain and Portugal. And speaking of which, both of those countries also had their credit ratings cut by S&P. Spain today and Portugal yesterday. Not surprisingly, the stock markets in those two countries were slammed particularly hard in the last couple of days. In the US, however, the market largely ignored the event, apparently predicting that the rout won't broaden. We would not be so quick to dismiss the fallout from Europe's woes, however. The size of the bailout required to avoid a Greek default being discussed now spans a wide range, but there is growing belief that up to 120 billion euros, that's the equivalent of about $160 billion, is needed. Which is a much bigger amount than the original 45 billion euro rescue package that had been pledged. The talks between the Greek government and the EU and the IMF are still continuing. On the one hand, a bigger rescue package should temporarily calm investors' fears. Today's market action, as well as indications from euro trading and Greek bond yields, seem to suggest that it's working, that it's working somewhat. But on the other hand, it's only a temporary fix, and it's up to Greece to fully dig itself out of the hole that's currently, as you can tell, very, very deep. That's it for today. Thank you for watching, and join us again tomorrow.